Hello, Nasdaq followers, and welcome to another edition of Nasdaq Spotlight. My name is Leanne Alfaro, and we are here live in Times Square on the heels of iGlobal REIT Summit. Joining us right now is Jeff Lenobel, partner at Schulte, Roth, and Zabel. Thank you so much for joining us.
Thank you for having me here today.
So could you tell us, just to kick off, a little bit about real estate financing trends that you've seen this year so far?
Sure. I think before we talk about the trends, maybe we ought to just figure out for a minute where we are. Sure. And I think what's coming out of conferences and issues that people are writing about, you see that everyone's expecting lower returns today. Mm-hmm. And so what was happening over the past few years is not quite happening as well now, where the real estate returns are not as great as they used to be. Secondly, I think people have to look at the demographics today. The age group of 75 and older are the largest and fastest growing group in the United States today. So people have to think about the trends that follow the demographics. And third, I think people are interested in what the foreign investors are doing, because they've been part of real estate growth both on the debt and equity side for the past 5 or 10 years. So what are the trends we're seeing? I think multifamily is still king. I think people are looking at multifamily as still the most profitable and the most recession-proof and cycle-proof kinds of real estate investment you could possibly make. I think people are optimistic but careful. I think the two big words that pop up all the time are taxes, our taxes and what's going to happen with our tax overhaul and how that's going to affect what we do, and tariffs, how that's going to affect the real estate market as well. So I think people are optimistic about foreign investment, but they have to be very careful. We see more foreign investment coming from Europe now than we do from Asia and some of the Far Eastern countries rather. And that's changing the real estate environment a little bit. And the biggest change, I think, in real estate financing is who the lenders are. For years, borrowers went to banks. They got their 65% mortgage. They went to the institution that they'd gone to time and time again. Then they had to go find a little bridge money, a little mezz money from somewhere else. And then came 2008. And the FDIC and the OCC started putting some regulatory restraints on some of these institutional lenders. And memories take a long time to be forgotten. Banks just don't lend in the same way that they used to lend. So there was a void. There was a void especially in the bridge loan market and in the mezz loan market. And private equity just came in and gobbled it up. And there's been a tremendous influx of private equity funds being formed today in order to raise money for the debt side as opposed to the equity side. We see, and from what we've heard from surveys we've looked at, over 60% of real estate financings are done today by private equity firms on the commercial loan side as opposed to the residential. And these are complicated loans, one-stop shopping for borrowers. A borrower can go to a private equity firm, get its mortgage, get its mezz, tranche it out. The private equity firm will then sell its mezz to some other of the investors that it has on its plate. And it's so much easier for a borrower to go in and deal with one entity rather than dealing with others. And the restraints and the LTVs and the amount of cash being obtained and the underwriting being done is different. Is it different now than it was in 2006 and 2007? Yes, but it's a little more aggressive, a little more opportunistic for the private equity firms than it is for the institutional lenders.
And so you've already touched on this, but how has the role of private equity firms evolved over the last years, and how do you expect it to change?
It's interesting. High wealth individuals and foreign money used to like other kinds of investments in real estate. For example, we used to represent a foreign investor that used to invest in single assets. So they would do all the due diligence work, they would look at the assets, and they would invest a substantial amount of money in a large asset. They found that the work that was going on in consummating these transactions was voluminous. So they decided, let's stop doing this and let's start investing in a real estate debt fund or a real estate equity fund. And so let the fund managers who really know the real estate, who really know what they're doing, invest. So you've seen a shift of foreign investment from the single asset investment to a fund investment. That's number one. I think people are steering away from hedge funds to a great extent. We've all read about the problem that some of the hedge funds have, and we see a lot of investors moving from hedge funds into private equity, and real estate being a safe private equity investment has sort of helped the private equity side grow. And I think the private equity firms themselves, like the debt side, it's a little more risk adverse than going into the equity, going one level higher up the ladder in the real estate ownership than it is on the debt side. On the debt side, you're like one step away. You can always foreclose, you can always sell your loan, many more options, and I think private equity likes that, and the returns are pretty good. Even in a low interest rate environment, there have been very few foreclosures, and things are pretty safe for a real estate lender in today's world.
Now, Jeff, talk to me a little bit about opportunistic and creative developers. How are they able to consummate a successful project and add value without taking too much risk?
That's a really good question, and it really is hard to be a good creative professional who can foresee the future. I overheard a conversation this weekend where there was a real estate developer who over the past 2 decades bought 12 million square feet in Williamsburg, Brooklyn at an average price of about $6 to $8 a square buildable foot. Foresight. 15 years ago, I represented a big developing firm who bought a ton of space in Long Island City. Foresight. We just represented a real estate development company that was a bunch of funds who invested on a large project on the west side of Manhattan, buying an old car dealership building and created new state-of-the-art car dealerships, have created an environment of 150 square foot of space for like a WeWorks company to come in and use that space, and sold the upstairs to private equity firms. I mean, being creative, making your property, having many uses. It's sort of, you got to just have a little foresight, overcome some of the transportation issues that you would have. Look at Hudson Yards, for example. No one ever thought that anyone could develop something on 11th Avenue and 30th Street and be successful in doing so when there was no transportation there, no facilities there, no infrastructure there. And look what's gone on there. It's a smashing success. You have these buildings are soaring, buildings are rising. We have businesses, law firms, and now residential buildings opening and selling out. So there were people who tried to develop Hudson Yards before the current developers did, who were not as successful, who were not successful and gave up their rights to develop it. But people had a little foresight, was willing to spend a little bit of money, and took the opportunity and chance to do it. So it's you got to be creative, and you got to take some risk. No opportunistic investor or builder or owner is ever going to be extremely creative, add value without taking some risk. It's just you try to minimize the risk to the extent you can.
Well, Jeff, thank you so much for joining us. Really appreciate the insight on the real estate financing trends, and we look forward to seeing you back at Nasdaq soon.
Thank you so much for having me. It's been a pleasure.
Nasdaq followers, stay tuned for more coverage here as we prepare for the iGlobal REIT Summit happening right here in New York City.